And the controversy with the CBAM is that, at least with regard to sales in the European Union, a carbon tax now applies to companies located in countries that have not adopted a carbon tax. So the United States is considering adopting its own outbound carbon tax, which would largely impact imports from China, honestly, not so much Europe, because the products that are producing are not producing as much carbon as certainly as China. But if China then adopts an outbound carbon tax applied to the United States, in effect, that would cause the U.S. to have created its own domestic carbon tax, but one that's administered and collected by foreign countries. All very interesting. And I also want to talk a bit about this global wealth tax proposal, which could be in a BEPS 3.0. It's still very much in its infancy, but it would be a 2% annual tax on wealth above $1 billion. And I think the way that it's structured, the way I understand it, is not so different from Pillar 1 Amount A, in the sense that it would be like a global individual wealth tax, and if it's applied like Pillar 2, one could imagine a scenario in which France asserts the right to tax an Elon Musk or a Jeff Bezos on the increase of their wealth in a given year. So that's my introduction, and then actually no, I'm going to talk a little bit more about BEPS before I pass it on to Daniele. I wanted to talk about what happened with Trump when he came into the White House. He created this presidential action essentially against the OECD global tax deal, and he's threatened the rest of the world with retaliatory taxes for taxes that the United States determines to be discriminatory. And the U.S. actually has a structure for this. It's in Section 891. So if the U.S. concludes that another country has adopted extraterritorial or discriminatory taxes, 891 provides for a doubling of tax rates imposed on citizens and companies from that country, including individual income tax rates, corporate tax rates, and withholding tax. The statute grants the president essentially no discretion to vary that rate in either direction, up or down. So it also doesn't give the president any authority to sort of impose the tax on a subgroup or of a foreign country's citizens or corporations. It's sort of an all or nothing proposition. If found to be discriminatory, these taxes apply. So so as Daniele has pointed out in our discussions before this, companies that transfer their factories to the United States to minimize the impact of tariffs may still get caught up in Section 891. So we think that's probably not exactly what the Trump administration has in mind in applying this section, but that is probably going to be the outcome. And then the other thing that happened recently was that Representative Jason Smith, who's the head of the Tax Writing Committee in the House, introduced a bill, the Defending American Jobs and Investment Act, after Trump had threatened Section 891. And this new Section 899 would be even worse than Section 891. It would require the Treasury Department to identify extraterritorial taxes and discriminatory taxes enacted by foreign countries. I think the UTPR would be exactly in the crosshairs of this tax. And then after these so-called unfair foreign taxes have been identified, the tax rates on the U.S. income of wealthy investors and corporations in those foreign countries would be increased by 5 percentage points each year for the period that the country has those discriminatory taxes in place. And it would peak out at 20 percentage points while these discriminatory taxes are in effect, but then these reciprocal taxes would cease after the foreign country repeals its discriminatory taxes, but the tax would remain dormant as long as countries avoid any unfair taxes on U.S. businesses and workers. But it's interesting. So it talks, unlike 891, which depends on the U.S. Trade Representative and the Commerce Department to determine what's discriminatory, this Section 899 describes exactly what is an extraterritorial or discriminatory foreign tax. It says that if the U.S. applies to income. It's a tax applies to income that wouldn't be taxed in the United States. Under U.S. laws, it's discriminatory. If the tax doesn't use the same formulation as the U.S. in terms of calculating that income, it's discriminatory. If the tax is designed to carve out domestic companies in the same industries as those that would apply in the United States, it's discriminatory. And if the tax isn't an income tax as defined under foreign countries' tax treaties with other countries, then it's discriminatory. So it's pretty wide-ranging and sort of easily encompasses a lot of the Pillar 2 anti-abuse rules. So if the taxes that other countries are applying aren't determined to be discriminatory under Section 891, if Section 899 is adopted, and it very well could be later this year, then that casts a much wider net. And essentially, I think any tax subjectively that Congress determines is going to be discriminatory will fall under that provision, so they can sort of apply it to anything. Okay, now I'm going to let Daniele talk about the VAT issue.
It's very interesting what you're saying, because we are waiting for this report, because we want to know which could be the new definition of territoriality of a tax. From this perspective, consider, it's not on the slide, but I had in mind, years ago, I think it was before COVID, it was the first article I wrote for Bloomberg years and years ago. It was about a kind of a tax assessment on Netflix. At that time, Netflix had not, in Italy, not a structure, not workers, nothing, just the algorithm. The point is that the Italian tax authority said that the algorithm allow Netflix to produce value in Italy, because the algorithm suggested to the consumers which movie to see and so on. Is a kind of advertising. So it's a kind of internal advertising. In some way, somehow, they say the algorithm is able to produce value within the country, also without any organization. And this is the notion of permanent establishment, of virtual permanent establishment, that the action line of the BEPS has introduced. So the point is, this is to say that the international tax framework is, I don't think we need to change the international tax framework. The problem remains the same. What we need to look at is how is the value chain, how is the mechanism of production of value, and then to articulate taxation over the new business models. That's the point. When you were saying about the retaliatory measure and so on, I can understand that the new administration is focusing on the tools to defend, but sooner or later, we both need, when I say we both, I mean the EU and the US, I'm not talking about the OECD or the UN and so on, let's say the Western country in general. I think that from the tax perspective, and not only, we share the same problem. So sooner or later, we need to find a solution that is good, is a win-win solution for both of us. And I'm convinced that sooner or later, we can achieve this goal. If you allow me to go back to VAT, but the president said on his fair and reciprocal plan that could be also a discriminatory taxation. The point is, VAT is not a tariff. The VAT is a taxation on sales. It's a sales tax like you have in the US. But the point is, if on my perspective, VAT is totally neutral. What does it mean? VAT is creating a common play field for businesses or working within the EU. What does it mean, neutrality? So the point is, if I buy a car from a French producer, I pay VAT in France. If I buy a car from a Japanese producer, I pay VAT not in Japan, but I pay VAT on the custom. Then, if I am a business, So if the buyer is a business, I can deduct the VAT paid on the VAT I charged on my client. With this mechanism, at the end of the day, the only passive, the only subject that has got to pay the VAT are the consumer. This is how the neutrality works. And if I may say, from the substantial point of view, also tariff, at the present moment, we are used to listen that firms, there may be someone convinced that the foreign firms will buy US tariff, will pay US tariffs. But from the substantial point of view, I have got to say that this may not be true, because at the end of the day, the consumer, the US consumer, will pay the tariffs. So from this perspective, I'm asking if with the, let me say, if it may be useful for the federal government to adopt a kind of US VAT, federal VAT for consumption that is different from the sales tax you have got now in the US, instead of tariffs. Because at the end of the day, there are many countries around the world. Now VAT in the EU is more than, he has got more than 50, is 53 years old. That is the first tax we introduced at the EU level. And somehow it works in a proper way. But it's just my opinion. So just to fix that VAT is neutral and tariffs are not. So this is the big difference between VAT and tariffs. And for this reason, for the neutrality of VAT, VAT cannot be considered as a tariff. And so it cannot be considered discriminatory. This is something we say between me and you and someone else. Maybe I hope that it's clear enough for all of us.
Yeah, no, that makes sense. And actually, it's interesting you suggest that the United States should adopt its own VAT. I think that's inevitable at some point. I know that's a controversial opinion. If the United States does adopt a VAT, we would never call it a VAT, because that name is the third rail of politics.
You will call John, you will call in somewhere, but I think that I think that tariff, when in the last few days, maybe yesterday, or maybe this morning, I don't remember, I read that the President Trump wants to introduce a kind of global tariff. But at the end of the day, a global tariff, if you consider a tariff that is neutral, is a kind of VAT. Maybe to call this as a tariff and not as a tax, in terms of political marketing, is more useful. But if we look at the substance, I don't think that many things changing. The only things that VAT is neutral and tariffs are not. Consider, for instance, the problem you may have with cars produced in Mexico, and maybe there are part produced in Mexico and part produced within the US. If you put VAT, you will tax the exact amount of value produced within the US, and the US consumer will pay the VAT just on the value produced within the US. So neutrality means also justice from the perspective of the taxpayer. But this is another point. We will talk about that another time.
Yeah, agreed. So I wanted to now shift into the interview portion of this webinar, and I wanted to start with Pillar 1 Amount A. So I think the understanding on this end is that if the U.S. doesn't agree to Pillar 1 Amount A, then it can't be put into place globally. So what happens if the U.S. refuses to agree, refuses to even negotiate on Pillar 1 Amount A, which looks like is what's going to be happening right now?
Andrew, the problem, it's not a problem. I mean, we don't have to ask what will happen, because we need to look at what is happening. single, at the moment, single EU member countries, but also the UK, that is not a EU member country, adopt a digital service tax. So taxation on the global amount of revenue of the digital company. The point is, let's go back to what we were saying before. In the business model of digital company, a part of values is produced where that data are available. So the point is, if this is true, and this is the point to, if we agree to this point, there are some jurisdictions that they want their fair amount of tax. So the point is, or with amount A, you have got the right of taxation to the single country, or in another way, the single country will take their amount in terms of digital tax. And at the present moment, for instance, in Italy last year, we had a directive, a EU directive, and some countries like France, Italy, Austria, and the UK outside the EU adopted this law, but they didn't collect the tax until there were the negotiation of Pillar 1. Without the negotiation of Pillar 1, so without the Pillar 1 on the horizon, they start to collect the digital tax. And I think that this is the situation, some way, somehow, if nothing happened.
Okay, so do you think it's possible that countries would put their digital taxes into place and then try to adopt Pillar 1 Amount A individually on a country-by-country basis, so they would have both taxes?
I would say, from my perspective, Matt, it's just my idea. Let's go back to what you said before, that the business model of digital company consider the algorithms and consider the data as the propellant. So if we think to the cars, we might consider that we are going to pay taxes on the oil at the end of the day. In Italy, we pay excise on the oil. And some way, somehow, we may consider the digital service tax as the tax that digital company pays for the consumption of data from this perspective. So it can from my perspective, this is just my idea. The point is to transform digital tax from a kind of direct taxation to indirect taxation. So a taxation on the consumption. But it's just my idea. About digital service tax, I've got something else to say, but I will say later when we'll talk about the UN.
Okay, and I wanted to talk a bit about the multilateral tax instrument as well, because I think, as I mentioned at the beginning, I think effectively the United States could never adopt something like that. I mean, to get 66 senators or more to agree to anything is probably impossible. So adopting a multilateral tax agreement in the United States could probably never happen. And I would assume, I don't know how it works in other countries as well, but I think that's probably the biggest hindrance to adopting something like a Pillar 1 tax, or if you wanted to get everybody on the same page with a global digital tax or something like that. So so like, what happens? I mean, maybe in Europe it's possible, but I can't imagine that that there must be other countries like the United States that adopting something like that.
Without, let me say, the Pillar 1 and the Pillar 2, mostly the Pillar 1 cannot be adopted without the US, because without the US, there is not the space. The Pillar 1 cannot work without the US. The point is, at the present moment, I don't see the possibility to start a negotiation referring to Pillar 1. I personally, I think that at the present moment, let's say today, is very difficult that the US will negotiate something in terms of taxation. Maybe the only possibility that I can see today is not to negotiate about Pillar 1, Pillar 2, or DST, or digital tax. The point is at the present moment, President Trump adopted tariffs. And so, let's say after the 2nd or the 5th of April, I don't remember exactly the day, within the new environment, maybe it will be possible to negotiate the whole framework. When I say the whole framework, I say, let's start with Pillar 2, and then let's see what happens regarding tariffs and Pillar 1.
Mm-hmm.
I don't think that there is a concrete possibility to discuss about Pillar 1 at the moment. So I think that for the moment, European country and will adopt digital tax. Let's see what the US will say in terms of extraterritoriality and so on.
So I think that there's a general sense, if not in France and Italy and Germany and the UK, or in the United States, that then maybe in developing countries that BEPS hasn't, BEPS 2.0, the Pillar 1, Pillar 2 project hasn't addressed all of their concerns. So even if some countries are happy with where we've gotten so far, I guess my question is, do you think we need a BEPS 3.0? Do you think the process is going to continue from here on out? And if so, I'm going to combine a couple of my questions here. If so, do you think that the OECD can marshal the process, or does it have to go to a different venue like the United Nations?
I think that we can discuss wherever you like, but the point is that without the US, no negotiation makes sense. So the point is, I am, it's not the right way, but I am going to answer to your question with another answer. Is the Trump administration available to negotiate something, or the new administration just want to isolate, put tariffs, and then let's see what happens?
Mm-hmm. Okay.
Secondly, at the present moment, the US is not within the UN committee. They went away in February. They said we are not interested in that. So it may be a good occasion, but it's not the right place. Maybe the OECD at the present moment is not even the right place, because at the end of the day, the OECD some way, somehow, I don't want to say, but some way, somehow failed, because Pillar 1 has not been approved. Pillar 2 has been approved, but with many is very, very technical. Pillar 2 compliance is very, very technical, even too much for in my opinion, if I may say so, something. And so I think that the OECD at the present moment had the occasion to say something. But wherever we talk about taxation, I think that we need to start from the BEPS. I don't think that it could be useful to put the BEPS outside from the windows. We need to start from there. And maybe we need to start from there, facing the new environment that the Trump administration is going to create. I mean, tariffs and this and this and this.
Mm-hmm.
Tariffs, digital tax, and so on. But the point is, I want to go back to what I said before. BEPS were the answer to the aggressive taxation policy of multinational in general. Nowadays, maybe the situation has changed also because there is a kind of reputational approach to the taxation. I mean, 10 years ago, if you buy a mobile phone, and I'm not saying the brand, but if you buy in Italy a mobile phone in a shop, we discovered, the Italian tax authority discovered that revenues from the purchase were not Italian revenue, but were Ireland revenue, because in Italy, the company paid just taxes on the revenues coming from the marketing consulting. So at the end of the day, BEPS was the answer to tax the substance. And some way, somehow, I would say that today, the situation has improved. So from a certain perspective, maybe a company pay taxes on the substance some way, somehow, and the environment has completely changed in the last 15 years. So the point is nowadays, for instance, you said before, is correct. Globe has a kind of exemption for the substance, but the substance is connected with the payroll and with the total amount of the asset. What does it mean? That, for instance, if you have a plant in Hungary where the corporate tax rate is 9%, so below the floor of 15%, but in Hungary you have the plant, you have people working on the plant, maybe 9% is enough because you have got the substance. The point is to maybe to create, to agree to a new concept of substance regarding digital company. And maybe we need to go back to the digital business model to understand properly how to tax.